Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining us today as we take a look at this year's presidential elections and stocks. Now, John Blank is going to be doing our presentation today. John is the Chief Equity Strategist with Zacks Investment Research, Incorporated. Zacks is also included on the Trader Workstation platform as a research provider. And at the end of today's session, I'll show you where you can access that information for those TWS users. But with that, let me put this over now onto our presentation slides. And John, I see that you've unmuted your phone. Can you give us a quick hello?
Hello, everyone.
Okay, well, I'm hearing you clearly. So what I'm going to do at this point is pass you the ball, and let's get started today. Thanks, John.
Thanks, Cynthia. Thanks, everybody, for coming on to the call today. Done this call a couple times for different groups, but I have some updated material today on our discussion. And what I'm going to start with is the Brexit, which is obviously behind us, not too far, only a couple of weeks now. I want to get into some of the similarities in the election pattern between Brexit and what may come to the United States from it. So, first of all, what's interesting about, from a United States perspective, on what happened in England is the town that led the way to the independence, the Brexit movement, is Boston, England. Now, amongst the Leave regions, I also saw Great Yarmouth and Northeast Lincolnshire. If you know the Massachusetts Bay Area, you know Yarmouth is down at Cape Cod and not far from Plymouth, and Lincoln, Massachusetts was a part of Concord and spun off. And the fourth place that carries the same name is Fenland, which is the Fenway Park area. So there's clearly a connection between this Boston area and Boston, Massachusetts. Now, this gets us to one of the very core facts of the revolt, is that it's a real, true English revolt. It is not a UK revolt, and it's not centered in London. And so this is what has to be understood here. These are the English people, and always Boston, England has been, from all the way back in the 1600s, have a very unique establishment of government and a very unique way of doing things. So all of this was very clearly understood by Nigel Farage when he took UKIP, the United Kingdom Independence Party, and he targeted these areas. So it's not a mistake. It's unmistakable. Nigel Farage knows his English history, and he put, and you can check with Economist Magazine footage on video. Just type Economist Nigel Farage, Boston, England. You will find 5-minute videos on his UKIP party establishment in the Boston area of England. So Nigel Farage knew what he was doing. He knew that the older people out in the country, in the English countryside, not Scotland, not Northern Ireland, and not Wales even though Wales joined later. This was an English thing, and Nigel Farage targeted it. So he knew what he was doing, and he played this game. Unlike people in the United States, he played the UKIP game for 20 years. And his target for UKIP is not now. If you watch the videos and listen to him speak all the way back in 2015, Nigel Farage was targeting the 2020 elections and build the UKIP party then. So he has no trouble stepping aside because it was never his plan to win now. He's a much more subterranean, and he's frankly a much longer term guy. He's playing 20 years out. He's playing for 20 years, and he's playing for 2020. So the other thing we want to point out is who the stay regions are. The two great university towns of Oxford and Cambridge are stay regions. Obviously, these are where the real educated, outward-looking parts of England are. The other parts, obviously, London, the capital London, which only an hour or two away from Oxford and Cambridge, basically Greater London is all of that, is not in on this whole English revolt thing. Nor have they ever been. I mean, even back to the United States history, you have to realize, all the Oxford, Mississippis, and all the Oxford names in the United States are Southern names. They were not Puritan names. This is another part of England, and it's the more established part of England. Also, Edinburgh, Scotland was one of the big stay players. All 32 global council areas went with Scotland. So there's a real strong case for Scotland to stay in the European Union based on the same voting patterns that people are getting out of on the other side. So the City of London is one of the top state players in the list. And I want to clarify that the City of London is not London per se. There's places like Hackney and Haringey and Lambeth, other parts of the boroughs of London that vote strongly. But the City of London itself is the ancient financial center of London, and it went out. Now, the most interesting thing to think about in terms of who wanted to go with Remain is Gibraltar. Gibraltar is a little rock off the coast of Spain that's been a part of England for 300 years, and not surprisingly, it and Northern Ireland chose to stay in the UK, and the answer is pretty simple. All of these areas have massive exposure to the EU directly right at their border. So Northern Ireland obviously deals with the Euro and Ireland more than it does England itself. Gibraltar is in the Mediterranean, has always dealt with Spain and the EU first and foremost. The City of London, with its passport issues with the EU, is again more hooked to the European Union than to England itself. So the main point you want to get out of all this is that this is a battle between England, and the UK as it stands. The UK, unlike the United States, is a much more simpler United Kingdom. It is 5 parts, and 2 of them, Wales and England, are the Brexiters. The other 3 parts, London, Scotland, and Northern Ireland, are not. And you know, the way to look at it is it's 3-2, and clearly the strength in those 2 areas swept the other 3 areas out of the way. But it's not clear to me at all when you have a geographic dispersion like this that it's anything but contentious for everybody. So let's go on to my next slides here, showing that distribution, and then I want to get into the Bernie Sanders and Trump case. And again, these are stories that are now past us in the sense of Bernie Sanders, but I don't want to jump too far into the moment with the United States without giving a little background on where we have come. And obviously we've come this far with 2 insurgency campaigns. And the big thing to understand about insurgency campaigns is they're like the English situation in the Brexit situation. It's an anti-establishment drive. As Sanders himself put out the vote, if the turnout is high, we're going to win. If the turnout is low, we are going to be struggling. So the first thing you learn from the Brexit, and probably is translatable to the United States situation, is turnout may well be high for the November election because these are insurgency campaigns. There's a lot of interest, and it's coming from very, very different sources. So I would expect the first thing you want to know about the whole situation we're in is that it's going to be, without a doubt, likely to have a lot of turnout in this type of situation we're in. Now let's go further on into this situation and take a look at what an Air Force fighter pilot had to say about Trump himself. I really like this quote, and it kind of, again, gives us some background on what's changed here from where he started. The quote said, "You have to spare a little grudging admiration for the sheer madcap genius of Trump's ability to disrupt, unsettle, and exploit the primary system." Now, obviously, he was talking about the primary system. We're no longer there. One of the interesting things about Trump today is that Trump has booted out his campaign manager that did this strategy during the primary system, and his daughter and his daughter-in-law, or her husband, is in their 30s, and they're basically advising Trump now. So the curious thing about Trump, unlike Nigel Farage, he has no party organization. He has no boots on the ground. This is not a similar situation for Donald Trump. However, I would say what's also interesting and comparable is the conservatives who have taken over to do the Brexit in England are very senior conservative politicians who've been in the game for decades. And this, in irony, is while I used to say Boris Johnson looked like Donald Trump and was the Trump of England, I am beginning to realize that the difference between the Brexit and the post-Brexit situation in the United States primary times and now the election for president is that, in fact, the Clinton camp looks a whole lot more like the Brexiters than the Trump camp. Trump being he got rid of his campaign measures and is working with 35-year-old people helping him advise. And the Clinton camp is now basically recycling old names that came along during a 20-year period. So I think the one thing you can think about in the English to the United States situation is that we've got a situation where people try to recycle their way back into the game. It's all a bunch of musical chairs. And the guy who pointed out this whole concept of an interregnum was a guy whose name was Antonio Gramsci. He was in his 40s, and he was trying to take on Mussolini back in the day. And when he took on Mussolini back in the 40s, Mussolini was a dictator, and he put him in jail, and he let him literally rot for 15 years until he died. But what he pointed out is that what this tells us is we're in an interregnum, and the quote he has for us is this: "The old is dying, and the new cannot be born. In this interregnum, many morbid symptoms arrive." So the idea here is that the old is dying, but it's not gone, and the new cannot be born. So we saw this with the Brexit, which is the older people are not dying, they're going to stay, and the London young people wanted to stay in the EU, couldn't overwhelm them. So the old is going to stay on for another 3, 2, 5, 6, 8 years, driving the system in a direction the new simply do not want. And we got to think that the United States is in no different a situation where we have camps based on demographics that are in a very different perspectives on the outcome for the United States. And so I would think that is another similarity between these two situations, is that we've got an interregnum underway where we may look back at this period as the last gasp of an old age and not the start of anything new. And that's kind of my view of this whole situation, is that the presidential election in England are showing us parallels, but the parallels are getting much more subtle. Some of the insights are shifting hands, and we're going to learn more and more from looking at both as we go forward as we do. Now, obviously, any stock talk with presidential elections has to go to just simply how is the stock market looking, and I pulled these slides a few months ago, so I don't have the run up to the stock market from its lows to its highs over the last month or two. That's clearly showing us, though, that what has happened here in the last year is that there's been a stagnation in that red line, which is the earnings path. Now, obviously, some people are saying, well, look, this is like the 2007 where we get to a peak and then we climb all the way down to 2009 levels. You can see that big collapse took the stock market down. Now, I will point out that frankly, is not the period of time I would point to. I would point to that 98 period. If you look at 98, we did have a financial crisis. We did have a currency crisis in Asia. And it was something that sent the earnings sideways for a good year or year and a half. And if you look at what happened after 98 is we did have the tech bubble, and it drove us to new highs for the next 2 years. So my answer of where the presidential cycle is in this scenario. My belief is that we're in another period for 2 years of where we're going to get into higher highs for the stock market and more earnings growth going forward. This is my view. I think when you look at this chart, your better bet is that we just exited 98 and are entering 99 than that we just exited 07 and we're heading into 08. Obviously, everybody has their own views on that, but I think whenever you talk about these generalities between stock markets and election cycles, you've got to ask yourself, where am I now? Because I think, frankly, earnings, and this is no surprise in Zacks' call, is the driver. But why hasn't the second quarter earnings mattered a lot in this situation? Because I think this market is looking forward. And we're in a July period moving into November. We've got the Brexit out of the way. We've basically got the Fed out of the way, and we're probably going to get a rate cut from the BOE here in August. So given that you've got equity markets being driven by interest rate fundamentals out of Europe, and also the restoration of an earnings cycle upside in 2017, everybody's betting on that. And basically, with an election in play in November, while you're sitting in July, you've got this whole template to run a bull market all the way into the election. So my basic view is that that's what's going to happen. And now let's take a look at where that figure of my bull cycle into the election fits into the situation we're in. First of all, let's say this. Republican presidents are not better than stocks for stocks. It's not true. Democratic presidents are better than Republican presidents. So I want to basically discount that. If Trump gets elected, it's not like we're going to see a boom. But the more important point here is the Ned Davis point on presidential cycles. What you see here is that we are in an election year, which a 9.5% return. On average, election years are bullish. The years after elections are bearish. So my bullish call into the November election from these highs is telling you that what we should expect, and however we get there, maybe economic, maybe financial, maybe just keeping the politicians spending on all of their elections, is we're looking at 7 or 8% more of a return in the S&P 500. If you think about it at 2,200 terms, we're looking at a 2,350 to 2,400 end if this typical outperformance comes in this election cycle. So I would tell you that there's only 3 years out of 21 election years, 3 years out of 21 election years that there's been a negative return. So if you're bearish about this stock market, I would tell you you are betting in the wrong direction based on what the presidential cycle tells you. It's actually bullish through the election and bearish next year. Now, one thing we've got to talk about is another context, which is the oil price and the S&P operating earnings. And so, again, here I've got the earnings in yellow and I've got the oil price in red. Now, what I want to show you over 25 years here is that effectively over yearly horizons, not monthly or quarterly horizons, oil prices tend to track earnings. So what this tells you is if OPEC gets out of the way, the actual price of oil really should be $100 a barrel. So, consensus that I read out of London is looked for $50, $55 a barrel, and I in fact agree with that. I don't think we're going to get to $100 a barrel. But I wanted to point out that these situations in 07, 08 are similar to the one we are now with oil, which is there's something not macroeconomic that's hitting the oil market, meaning something within the oil market itself is setting the oil market up, not the macroeconomic situation. I think that's the accurate statement, and we all know what happened in late 2014. It was the dumping of literally a year's worth of millions of barrels per day by the Saudis. They poured the oil onto the oil market, they drove inventories up, and they collapsed the price, and they continue to collapse the price. So this chart tells you that the energy market should not be evaluated on macroeconomic terms. It has nothing to do with it. It has to do with something within the oil market, and we know what it is. It's the Saudis. Now, that takes us to the other question of what sectors benefit from the campaigns. And there's 4 areas that I want to focus on. I've already spoken a little bit about the media and how it gets, money gets spent on media, and that drives some growth. But there's 4 areas we need to be concerned about as voters and as investors about what can happen with election spending as it affects the economy and therefore stocks. First of all, infrastructure spending. There'll be a lot of talk about this. Obviously, one of the things you try to build up is decided that productivity is falling, government can do something about it, and you're going to spend on infrastructure. Healthcare, there is no question. Drug prices, tax inversions with Pfizer outside the United States, the 9% GDP growth rate of Ireland is obviously all tax inversions, and frankly the Trans-Pacific Partnership, which is riven with exclusions to keep patent protection in place in trade, so you don't have to deal with generic drugs. So whether it's overinflated drugs in the United States on their pricing, moving profits out of the country, or using the Trans-Pacific Partnership to give a stealth deal to the patent companies, the patent producers, which are the drug companies largely, you're going to have discussions next year, not this year, next year on healthcare in those areas. I think the other thing you've got to really think hard about is the way these campaigns are going to deal with financial companies after the election. Significantly important financial institutions, the SIFIs, whether they're going to be broken up or not. Obviously, if a Democrat comes into play, there might be a greater chance for that, although I think trying to make calls on this scenario where there's flip-flopping and a lot of movement behind the screens, because you really have the new guys in the Republican Party that really would
go a different way, and you've got the old guys in the Democratic Party, but who's to say one's going to go the other way or who's going to be leading the ship? I don't think the answer is clean, but these are the issues to remind yourself of. Glass-Steagall can return. A captive treasurer and SEC, there's no question that for the last 6 or 8 years we really haven't had a treasury that's not captive to the banking system and the financial markets. So again, somebody may or may not take that captive situation on. The biggest thing, and the final thing I'll finish with, is defense spending. There's no question that defense spending is half, if not more, of the budget, and everybody's going to be strong on defense, and who really is going to spend on it, we'll have to wait till next year. I'm going to skip this slide and go to the next one, which is this idea of the earnings yield with the S&P 500. And again, it's actually, the reason we are bullish right now is this slide per se. We believe that basically earnings yields are high enough and that the slope down here is going to keep going. If you look from 2011 down, on a longer time frame, we're going to continue to drive down on the earnings yield. Obviously, the last 6 months we haven't, but that's just a temporary retraction. The path is down. And the other thing I want to point out with this slide is I get a lot of comments out of the media and a lot of Zacks subscribers telling me we're in the longest bull market cycle in history. And they're targeting this thing to 2008. Now, what I want to point out on this earnings yield idea is something that I think is more relevant, which is the earnings yield, meaning the real collapse in the stock market relative to its earnings, did not happen in 08-09. It happened in 2011 and, frankly, late in 2011. So we are, in fact, only 4.5 years out from that 2011 period. Now, this gets relevant in the same sense that if you think that we're only 4.5 in a real cycle that began at the European debt crisis ended, and that since Europe and the European Union are setting interest rates, and the U.S. is on for the ride here, then you have a bull market that's only 4.5 years old, and you have all the monetary policy coming out of Europe where the unemployment rate is 10%. Now, I don't have a slide today, but I have encouraged all of you to go to the unemployment rate for Europe, because the unemployment rate for Europe over the last 12 or 15 years will tell you a very important story. What it will show you is that Europe did one plunge in unemployment with us in 08-09, and it did another bigger plunge in 2011. They basically had two crises. We had one. And so the world right now, the world economy, which we do live in, is in fact, in my opinion, being driven by a European bull market cycle that has yet to really get going, and because it's stalled here. And it's only, once it gets going in the summer, is only 4.5 years old. So that's the other cycle we want to think about with presidential elections, is that it's not clear that we are just in a bull market because of what's going on in Europe. And again, whether it's oil, whether it's Europe, whether it's the Brexit, you can't pull the United States out of its story completely. However, the bottom line with voting, when we're talking about voting in a country, is economic growth of the given country matters the most. I don't think that's any, flash of insight for any of you, but I only want to put it on the table because I just spent 5 or 10 minutes talking about all this global stuff and open up with global stuff. The bottom line is all that stuff is second to the strength of the U.S. economy. And the bottom line is that voters reward governments for recent prosperity. So if you want to look to the idea of what the economy in the United States is telling us about who will win, the answer is Hillary Clinton will win if she sells herself as the heir to the Obama prosperity. And that is the idea of economic growth, that no matter what happens in Europe, no matter what happens in England, no matter how strong or weak the Chinese economy is, the bottom line is the U.S. economy, with the latest ISMs and the payrolls are telling us, is a 4.9% unemployment rate economy. There's very, very little chance of that changing into the election, which means there's very, very little chance that the incumbent party will not take advantage of that. So unlike 08, when we had an election in a collapse, this is an election where we have strong economics driving the benefits for the incumbent party. Now, again, keep in mind that all of this has taken place in this whole yield premium versus stocks thing. And I took this, again, this is a 2% 10-year rate. We're down, obviously, to 1.5. So we're even lower where this thing continues to slide down. So you're still looking at 25 years of a bull market for equity, for bonds that is still yet to find its bottom. And I frankly don't think anybody really should call the bottom, even at anywhere near 1%. It could keep going. As long as the Europeans keep the stimulus going, and they are going to do it through 2017, there's no reason to expect interest rates to go anywhere but down. So again, for the United States, what this means is there's no reason not to expect housing and general sense of prosperity to play itself out into the fall. The other thing I want to point out is, again, when that green line, that earnings yield line, it peaks in 2011, and it doesn't really start to go downhill until the end of 2012. So from this perspective, of the 11-12 perspective, not the 09 perspective, and I want to convince all of you that that's the right one, stocks are going to be in a bull market this year based on this earnings yield, regardless of earnings. Again, the strength that will be gained from a rising stock market, a sense of prosperity, is what I wanted to tell you about here. This is about presidential elections and stocks, but the bottom line is the backdrop is favorable to have a bull market, to have an economic boom, and very low unemployment heading into election that has to benefit the Democrats and not the Republicans. So, what to expect in 2017 based on who wins? When a Democrat wins, stocks lose 1%. When a Republican wins, they rise 4%. So, typically, from that statement I just made is from election day to year's end. So there's an interesting comment, about this. Is I told you Republicans are not better after the year after, but to the year end, for the next 6 weeks after an election, they actually are. I think what the answer is, there's a real short-term sense of euphoria for a pro-business government before it gets elected. And that's the bottom line here, is there's going to be a sales job and some euphoria before people realize not a lot's going to change. But in general, what you can expect is a rise through the election period. Again, a bull market for this year, and then basically things fall apart when people realize things really aren't going to change that much. And I think that's the bottom line with this whole idea, is that you could see a euphoric move after the election if Donald Trump wins, but it'll peter out after he gets into the House. And that's the idea we saw with the primaries, is that they're very different periods of time to be thinking about. I'll finish up here today. I hope all of you enjoyed my talk, and I'm going to tell you all that what we've got now is a market that we're finally seeing the end of what I'm showing you here, which is there has been for many months very little interest in stocks or bonds, and I think that's actually ending right now. And this is another indication of interest. We're seeing in Zacks a 20% rise in page views the last 2 weeks, and this is coming on the back of you can see here, 2 years of basically no interest in putting money to work. And I think for all of you, that's the good news, is that people are going to put money to work in this market through the election. And I won't go into my view on who should or should not win. That's really not the point of this call. But I want to make the case that, generally speaking, you should expect the bull market to November. Generally speaking, if a Republican wins, you should expect a little further rise into January. And generally speaking, you should expect next year to be soft for equities. I would also point out that my feeling is that Europe and the 4.5-year bull market is the right way to look at the length of this cycle, not 08, 09, because Europe is working out 2 crises, not one, and we are joining them for the next year and a half or 2. And with that, Cynthia, I know we have a chat option on this screen, and I wanted everybody to get a chance to close this call with their own comments and their own ideas. So go ahead and feel free to type up a question that goes into the chat window, and I'll go ahead and speak to it verbally, because that's when I can put this into the audio play and let everybody have a chance to hear it later on. So if you have a question, please go ahead and type it in, and I'll take a look at it.
And I want to, John, I want to remind everyone that they can access the chat panel using the blue bar that appears up at the top of your screen. So if you've got a question, go ahead and open up that icon tray, click on the chat panel, and you can send John your questions at this point. Now, also, while we are waiting for any questions to come through, I do have one piece of business I have to run during each of my events, and that is to elicit some feedback from you as well. So notice I'm going to open up a polling panel. It now appears over on the right-hand side of your screen with 3 short questions, and 2 are multiple choice. So it's open for just a short time. If you would make your selections, 2 of those questions are multiple choice, so we try and keep this quick. But also notice that in question number 2, there's an input field. If you do have any suggestions for other topics you'd like to hear more about in these webinars, simply type it into that input field. Polls only open another second, so please everyone click submit. Thanks all. That information is very helpful. Well, at this point, by the way, you can close that panel down and take it completely out of your way. I do appreciate that feedback. And we'll open this up for questions at this point, so keep that in mind. By the way, if you are viewing this not in full screen, simply double-click the chat panel and it'll collapse or open up so that you can view that as well. John, I do see a question here from, I would like to ask everyone to address their questions to all participants. That way we can all see and benefit any of the questions that do come in. I've got one I'm going to send to you as well, John, that came to me privately, but it looks like there's several that are popping up right now. So I'm going to send this back over to you. Thanks, John.
Okay, great. Well, we had a bunch of questions, which is terrific. I'll speak to them first before I answer them. Are there any general volatility trends during the election period? General volatility trends. I think you mean just markets going up and down. I think the answer is yes, there is volatility trends, not during the election period, but after the election period. I don't think you should expect any volatility. In fact, I think you should expect lower volatility into the election. The trade-off there that I think is totally wrong is if the polls start to get close, then I think you're going to see some volatility. But if the polls are staying wide and the mark of who's going to win is pretty clear, I think you should basically write it off and realize that there's going to be low volatility. But if there's situations where volatility picks up, absolutely. Precious metals mining stocks going forward. I'm bullish commodities. I just did a CIO survey of most of the major chief investment officers in the United States yesterday closing. They're bullish commodities, bullish mining stocks. So yes, the answer is bullish. But I would say gold mining myself, I think you take profits on gold and silver. That's just me. But I don't buy on to this whole weepy cry thing with gold and silver. But by and large, the CEOs that I have read are bullish commodities, they're bearish gold. I agree with that. That's my point too. Do you think it's better to buy ETFs or individual stocks at this point? To be honest, if you know what you're doing, I think, you know, like we talk about a Zacks #1 rank, a strong buy stock. If you're buying a stock with better fundamentals and upgraded earnings, it should outperform an ETF. Having said that, ETFs that are being, put in the right place always have to get a bid. And I think you should have a mix of both, but I think, taking your best ideas out of your stock market portfolio and staying with them or adding them, and then filling in around the edges with ETFs would be the way I would do this. Another question, given that we have seen a series of negative flows out of equities for the past few quarters, and a continued expectation of these negative lows are net neutral, how do you expect the market to continue to run upwards as money is beginning to move outward? Alex, my view is money is going to come inward, not outward. I think you're speculating that the market will continue to pull money out like it has a year and a half. I don't think so. I think, as Zacks we call it, FOMO, fear of missing out. Once you have a market rolling like this and you're a mutual fund manager looking to the end of this year, you've got to go 7 months and tell your boss that you didn't put any money to work. And when the markets are running like this, fear of missing out is going to drive that money back in. And it's been sitting out for 2 years. So I don't think the market's going to run downwards because I think the market's going to run out as money gets to work. So you're only right if money keeps being pulled out or goes sideways. I think fear of missing out is going to run that the opposite way. Another question, July and August are typically bearish. Is that also the case for election years? You know, I don't know if I have an answer to that. I think, no. I think election years are bullish July and August because you have so much focus on it and the Fed stays out of the game. And particularly now, let's talk about this July and August. We got a Fed that's probably going to stay out of the game because of Brexit, and we've got a B of E that's probably going to give us a rate cut in August. And we've got the interest rates incredibly low. And all of that's taken me down the path that I think, you know, not only is this election year bullish for stocks, but this particular interest rate cycle is bullish for stocks. Next question, is the bull market expected to continue next year? Are we seeing a breakout today? The bull market is expected to continue next year, in my opinion, and we are seeing a breakout today. At Zacks, the consensus is 2,300 for the end of this year, and I think you can look for a 2,400 number after the end of next year, maybe 2,450. The way I like to think about this in earnings yield terms is if you run that earnings yield down like you're seeing, all the way down to that 2% level from, you know, the slide I have up, from a 4.5% level to 2% level, you have an S&P 500 of 2,900. So the idea that this thing gets overvalued on an earnings yield perspective, and by the way, look back in the 90s, 1.5% and 2% earnings yield were common. So if you think we go back to that 98 period where the 1.5% to 2% earnings yield, we have 2,900 on the S&P. That's about it. Look at that green line. Ask yourself why that green line has to stabilize at 04, 05 levels. Why can't it, given the interest rate structure, very different than 04, 05, so much lower, why shouldn't we expect to go to those 97, 98 periods? Again, my thinking is 98, not 05 or 08, and my view is we got 2,900 on the S&P. We got a long ways to go. Do you have any views on British, European, and emerging market equities going forward? Yeah, I'm bullish them. You know, frankly, I own European stocks for the International Trader. They haven't gone anywhere for 7 months. They're really low. You've got to expect that the PMIs are holding up. You know, even through this whole period with Brexit, they got stronger. I got to figure as long as Boris Johnson doesn't get crazy with us and pass Article 50 through the Parliament, we're going to go on a bull run with these. The way I would think of it's going to blow up is if Article 50 passes in the Parliament, then I change my mind. Do you think that the unprecedented central bank involvement in bond and equity markets in recent years impacted the historical market response to elections? Absolutely. There's no question. It's enhancing it. We know that the historical response to elections is positive, and a 9.5% return is average for an election year. So yeah, it's enhancing it. We know that interest rates have fallen this year, 50, 60 basis points on the 10-year, which means it's enhanced that 8.5% return. So you can, doing your idea, and I agree with you, is a 12% return. And I think that's the idea here, is that it does impact it and it enhances it in this context we are operating in. And I've got a follow-up question. Given fear of missing out, do you expect a bubble to be produced given the sluggish growth and continued expectation of weak data? Expectations in history would dictate that a bubble would develop. Great final question, and I'm going to close out by re-speaking that question for audio and giving us all a pause to think about this, because I think this is exactly the kind of question we want to end this call on. As a follow-up question, given fear of missing out, do you expect a bubble to be produced, particularly given the sluggish growth and continued expectation of weak economic data? Expectations in history would dictate that a bubble would develop. You know, guys, Mr. Lawson, particularly thank you for the question. I hate to say it, but I kind of agree with you. I think this we're headed to a bubble in stocks. You know, the question you have to ask is the word bubble right. I mean, can I get to 2,900 and then there's a collapse to 2,100? Is that going to produce the idea of a bubble here? The problem I have with this market is I can see the stock market running all the way to 2,900 over the next 2 or 3 years. Then how do we get out of this? The problem with this whole thing is somehow we have to end 25 years. You see that yellow line I left on the screen? Somehow this has to end. Now, if you think that the last 4 years from 12, 13, 14, and 15, at the interest rate that we're going to see is just a low one, and we're going to go on for a few years. I think, we're talking about a bubble. Honestly, I think it will happen, but I think it's probably 3 years to 4 years from now. So I think you're absolutely right. It's hard for me to imagine that there's a euphoric end to this thing like history always says. It's also hard for me to imagine that's anytime soon. Because I think what's going to happen with this bull market driven thing is we're going to go to those 98 levels on equities, and the Fed or the ECB is going to keep us low for longer than any of us believe. And what we've seen from 12, 13, 14, 15 goes through 16, 17, and 18. We just get in a period where this long-winded, low-interest rate thing keeps on going. So that's my view. I do agree fear of missing out in a bubble. I'd like to be, tell you that we're not going to get out of this without a big crash, but I agree that the history proves that these things get out of hand and they have to correct. I would tell all of you, though, that my view on that is it's a lot longer away than you think, and the way to find the end of that is the real question. And what I'll finish with is, when do I think it's going to end and how should you deal with it? I've told people this before. It's a really simple exercise. There are too many statistics, there are too many economists, there are too many strategists, including me, who talk too much about this. And the answer is you should listen to none of us, and you should watch non-farm payrolls. Now, when I talk about non-farm payrolls, I want to tell you why it's what an economist calls a summary statistic, not a statistic, because it's summarizing all activity in the economy. You don't hire people unless your profits are good and your outlook is fine. It's just a 12 to 15 months horizon for hiring people. You can't get rid of people that easy. So when hiring is above plus 100 on a revised basis, and this is the other thing about payroll numbers, is too much CNBC and sudden jumpiness about the payrolls is what everybody cares about. I don't want you to pay attention to that. I don't want you to be that focused on it. I want you to pay attention to the revised numbers. And the reason is that because we're also jumping and getting on top of this number and making our way out before a recession, the government gives us that data 2 and 3 and 4 days after the month ends. So there are hundreds of thousands of firms selling data. That's why it's called the establishment survey, not the household survey. And frankly, they don't have time to get the right number in. We saw that in May. It was plus 35. Now all of a sudden we're back at 285. A lot of that, people, is revisions because we did a June 3rd number. We had 2 days to get all the firms in, and they just can't do it. So our impatience with the payroll number is one of the factors that I want you to discard. Pay attention to revised final data. And if revised final data over 3 months, now let me repeat that, if revised final data over 3 months is sub 100 all 3 months, meaning 60, 40, 30, or minus 50, 50, 80, you get in something like that, just get out of your stocks, period. Because you don't have to be a genius. You don't have to know anything. You just have to know that that summary statistic is showing you that whatever is positive in the economy is being overwhelmed by the negatives at that point in time for 1 quarter. And when that happens, get out. And until that happens, use that monitoring tool, use it religiously, pay attention to getting the non-farm payroll statistic on a revised basis. Do not pay attention to the moment it comes out because you are not listening to me and thinking correctly that you have a cyclical pattern. You want the data to confirm the reality, and the reality is you don't have to be the fastest guy on earth on this thing. Because if you think about it, when I'm talking about a 2,900 S&P, I'm telling you if you get out 3 months late, you're going to get out at 2,750 from now. Now, you tell your clients, I'm in the game from 2,200 to 2,750, and then I got out and lost 10% in the last 10, you're going to be a hero. No, I am not telling you how to time out the tops, and nor will I. But I will tell you, you will stay in the game longer and more comfortably if you pay attention to that metric and nothing else. And I mean nothing else in the sense that that is a summary statistic of the U.S. economy. It summarizes all the other statistics. It summarizes the ISMs, both services and manufacturing. It summarizes growth and consumption and stock market valuation. At the end of the day, that's what I'm telling you to do. And that means we have a monitoring tool in place, and we ride this bull even through the euphoric period until all things point to that this thing has finally catapulted itself into an unsteady situation, and it will take the dynamics down from there. So that's how I'll finish. I hope you enjoyed this scenario. I really appreciate having this many questions. It's terrific to see 10 or 12 questions in a conference like this, and I think they were great questions and a great way to finish today's topic. And I want to thank Cynthia for doing such a terrific job in teaching me how to use all these this slide operation.
Well, John, I want to thank you very much as well for some terrific insights today. Now, before we do exit, I do want to mention, I'm going to grab the ball back from you and actually take you out to the Interactive Brokers platform, because Zacks Investment Research has been integrated directly into TWS so that you can access that research through your trading platform. Now, let me bring up the Trader Workstation platform and show you where you can access it once you have made that subscription, and you will need to subscribe through our account management feature. But once you do have the subscription, notice that the analyst information is available right through the Mosaic interface. Notice here the different company reports. There's even free company reports available, and general market columns as well. Simply go in, and let's go into our general market columns, for example, and notice that the information is here and available. Now, I do want to take you to the Interactive Brokers website as well, because we do have a page that's been devoted to the investment research product. Here you can find out more, as well as how to log in and subscribe to the information, but you can also view a sample report and even visit Zacks' website. So if you do have an interest, please take a look at this information. By the way, what I'm going to do here is take us back over. We're going to stop the share, and what I will do is actually enter the same information into your chat panel. There's a direct link to that information page available on Interactive Brokers website. And I see that Maxim has a question. Do you have a PowerPoint with the webinar slides? And yes, we do. And by the way, as you exit today's presentation, you'll see today's slides will pop up as a drop-off link. It's you can bookmark or simply download and print directly from there. So once again, I want to thank John Blank for today's presentation. Excellent insights. Thank you so much, John.
Thank you, Cynthia.
And by the way, we've been recording, so if you'd like to come back and re-listen to some of the concepts that John discussed today, watch your email. In about an hour, I'll be sending out a direct link to today's recorded playback, and also be on the lookout for the notes. Well, once again, thank all of you as well for participating with us here this afternoon. You can exit the platform using the X in the upper right-hand corner of the screen. Have a great day, everyone, and all, please remember to definitely trade smart. Thanks, everybody. Have a good one.